And we are live. So thank you, everybody, for joining us on another Life After Hours. We might just wait a couple of minutes to let people filter in. And so go in the chat and tell me you're here. Tell me where you're from. And if you've got any questions, start cranking them in because after all, these events are as more about you than they are about me, and it's an opportunity to ask those questions you never wanted to ask. You can put them in the chat if you are happy to share them, or in the Q&A where only I will see it. So we have just passed over the 7:31 mark, so probably time to get going. No point in pandering to the latecomers. So thank you for joining us on another Life After Hours. I'm Vince Scully, and this is Life Sherpa After Hours. Before we get started, I think I should just acknowledge the Camaragal people, the earliest recorded inhabitants of the land that today we call North Sydney. And Life After Hours is the opportunity, the time of the month when we shine a light into the dark recesses of a personal finance topic. And tonight we're going to talk about portfolio construction. And portfolio construction is more than just picking a few random ETFs or stocks off an investment menu. They do need to be put together thoughtfully. And it's not just about picking the best ETFs, that just like a good football team, a team of champions does not make for a champion team. So it's how they all work together. You certainly wouldn't want a team of 11 full forwards, so or 11 strikers or 11 goalkeepers. So the key to it is finding a team that works well together. And we'll go through what that means. So having said all of that, let's kick on in. So let me grab these slides and start the presentation. So as I said, we are talking about portfolio construction. This is a slightly abbreviated version of a 5-part webinar series that I did for ShareSite, which you can find on our YouTube channel. I will put a link in that later in the evening, but very much stripped down. But this is broadly part 5, the pulling it all together of that series, and it is about the pulling it together. So with investing, as in a lot of things in life, for most complex problem, most human problem, there is a well-known solution that's neat, plausible, and wrong. And nowhere is this truer than when it comes to personal finance generally and investing specifically, and particularly on the internet. Nuance is probably the first casualty of the internet, and the constant search for clicks and eyeballs leads to simple and simplistic solutions that play well to the YouTube and Instagram and Facebook algorithm, but are hopelessly misleading. And so what I want to do tonight really is to unpick some of these nuances so that you can have a better chance at pulling together a winning portfolio. And these simplistic notions when it comes to investing, they're everywhere. So, many of the best-selling books and podcasts and forums on will emphasize that here is a simple solution. You don't need to complicate it. Just buy my simple tool. My good friend J.L. Collins wrote a book called The Simple Path to Wealth. And his key thesis in the book, which has got huge currency, is VTSAX and chill. VTSAX is a US managed fund, what our American friends call a total share market fund. What they mean is a total US share market fund, which invests across the spread. There's about 3,500 names in that portfolio. The Australian ETF VTS invests in VTI invests in that portfolio. So it's the same thing. It's a US total share market fund. Sure, the US is 60% of global share markets, but that's not a total share market fund. A slight variation on it is Lars Kreuer's book called Investing Demystified, and he says all you need is a global equity index. In his case, he is based in the UK. He's saying you should buy an MSCI All World fund, which is a developed market large cap index, and sprinkle in some high quality government and corporate bonds. How much bonds is based on your risk. So we're starting to get a little bit more nuance, but still a long way from reality. Lars's theory works fine if we didn't have currencies, if we didn't have taxes, if we didn't have different regulations, and everyone on the stock market was playing the same game. None of those assumptions hold true in practice. So again, simple but wrong. On the internet on Australia and in some very high selling books, the standard VAS VEU VTS portfolio. So VAS, Vanguard Australian Share Fund, ASX 300, VTS US Total Market, and VEU World X US. So getting a bit more diversified, but no bonds, no real estate, no infrastructure, no gold. Again, therefore, by definition, a suboptimal portfolio. So these are the simple solutions. And so if simple isn't necessarily right, however convenient, then what is the answer? And the missing ingredient in all of these portfolios is that it ignores the concept of volatility. When you look at any investment or any portfolio and you look at its returns, that number is largely meaningless without understanding the risk that you take to get there. So Paul Clitheroe, another veteran of the financial advice space, always asks the question, compared to what? When anyone says, my investments have done well, or I've done well, or my portfolio has done well, you've always got to ask yourself, compared to what? And that's the key. Now, volatility on its own isn't actually risk. And I'll come back to what it actually means. In technical terms, it's a statistical measure of the dispersion of returns for a given security or market index. And dispersion of returns is what's going to be really, really critical. In other words, the variability of the outcome. So when we look at investments of any sort, whether it's a portfolio or an individual share or an individual fund, we need to put it on a spectrum. And typically we graph this with return on the vertical y-axis and volatility or variability on the horizontal x-axis. And you really want to be in the as far to the top left as you can get on this graph. Now, clearly, high return, zero or no volatility just doesn't exist. So that's rainbows and unicorns territory, and you can't get there. On the other hand, low returns, high volatility, or high risk, is a place where you're being insufficiently rewarded for the risk you're taking. And one of the key elements in building an investment portfolio is that you get rewarded for all of the risk that you take. And that's why we don't generally look at individual stocks, because you're not generally being rewarded for the what we call idiosyncratic risks. So the risks that are peculiar to that individual business. The difference between buying CBA and NAB, they will behave differently, and picking the one that's going to do better over the next X period is next to impossible. And in fact, only 2 of the 5 banks have outperformed the index over the last 20 years. So, thing to be done very carefully. But there is a sweet spot in the middle where you are getting the returns that you need at a volatility that you can tolerate. And the next question is, well, where in that sweet wedge should I be? And that depends on how much risk you need, or how much return you need to deliver the goal that you've got for your investment. And so at that point, you're really trying to maximize the return you can get for the risk you're prepared to take, or minimize the risk you need to take to get the return that to get the return that you need. And that's the piece that's missing in those simplistic solutions. So that brings us on to the concept of risk-adjusted returns. And that is that I need to look at my return in the context of the risk I'm taking. So if I have 2 investments, both of an expected return of 10%, but one has higher volatility than the other, I would say that the one with the higher volatility has the lower risk-adjusted return. And that gives you a sense for maximizing your return. So when choosing between 2 options, you look at the difference between them in terms of expected returns. An expected return in that context means the 50% probability that half the time that asset or asset class will return more than that return and half less than that return. So the Australian stock market expected return, if you look at the 122 history, expected annual return is about 12%, 12 to 13%. The number of years it's actually delivered 12 or 13 is a handful. 25% of the time, it will return a negative return. And some years it will deliver more than 40%. But the point being is that when you average all of that out, the average annual return is 12. But because of those ups and downs, an investor who invested at the beginning of that 122 years, on the 1st of January 1901, happens to be Federation, so it's very convenient, would have realized 10% over that period. Because obviously when you get a fall, so when your portfolio falls 50%, it's got to double to get back to where it was. So the actual realized return on average will be below the average annual return. And that's why volatility matters. Now, our friends on Reddit, or our friends in the academic world, and in fact, even some fairly high-profile names in the financial advice world will go, volatility isn't loss. Volatility isn't risk. So Nick Murray, who's the advisor's advisor in many ways, says that volatility, while emotionally painful, and that's important, psychology matters, adverse movements in asset prices only hurt me when I sell. And that's absolutely true. So as long as you can hold through to the bottom, price movements have limited bearing on my life at that point. And the other argument is that volatility itself is not risk. And risk is also not, I'm going to lose all my money. So when we're dealing with broadly diversified portfolios, the odds of you losing your money are vanishingly small. There are clearly periods where the value will go down, but the probability of you losing every cent is close to zero. There are individual companies where you clearly can lose all of your money. In fact, almost half of all stocks ever listed in the US delivered a negative return to their shareholders over their listed life. But volatility is an indicator of risk. It's not a risk in itself, but we use it as a good proxy. And for retail investors, that is ordinary investors, not institutions, ordinary investors will have a goal for their money, whether that's putting your kids through private school, whether it's retirement, whether it's buying a boat, whatever it is. The reason you're not spending this money today is that you think you're going to do something better with it tomorrow, next year, next decade. And that goal has a dollar value associated with it. And your investments, the key risk that matters is whether or not you'll be able to achieve that goal when you want to achieve the goal. And volatility matters because it determines the probability of you achieving that goal. We'll see that in absolute numbers later on. So our friends on Reddit will tell you that you can only eat returns, that you can't eat risk-adjusted returns. You only eat the returns that end up in your pocket. And that's absolutely true. And the key here is that you've got to be able to stay the course, and you've got to be taking variability that fits with your investment term and your goal. So if I move on to the next one, and that's where asset allocation comes in. Now, asset allocation is a fancy word for saying, here's how you split your money across all the various asset classes. And this will explain 90% of the variability of a typical fund's returns over time. And in general, the higher the allocation to growth assets, the higher the expected returns. Now, that's not to say that every day asset allocation explains all the returns. In fact, in the short term, if you're trying to compare two portfolios with similar asset allocations, most of the difference is accounted for by stock selection or market selection or various other factors. And quite clearly, not all 80-20 or 70-30 or 50-50 or 60-40 portfolios are the same. And this is how this plays out in the superannuation space. So this is taken from the APRA data, so I haven't made this up. Each dot represents a superannuation fund. This is a 9-year return. And the vertical axis shows that, 8-year, the vertical axis shows the return over 8 years, and the horizontal axis shows the proportion of growth assets. So the higher up the graph you are, the more return you get. Further to the right you are, the more growth assets you have in. And they are hugely correlated here. Sure, there's a bit of noise around that. Part of that is how various funds classify infrastructure, real estate, and private equity. But as a broad rule, you can see that these graphs moves upwards to the right. The more growth assets you have, the more expected return you can have. Clearly, there are some laggards in here which show either incompetence or misallocation or market timing. And so when we try to apply the same thing in our portfolio, this is a couple of points in time which demonstrate how diversification works. So the first graph we look at here is the 2008 market crash, the GFC, or the Great Depression in our for our American friends. And there we had a market that peaked in November 2007 and continued to slide, out to probably mid 2009. So it was a long, slow, deep decline, and it took 3 more years to recover. That's a long time to sit on a decline, a portfolio that's in negative territory. So the teal line at the bottom, that's what happened to global equities. And as you can see, it took until 2013 for them to recover. The red line, which is the traditional diversifier being high-grade bonds, it moved in the opposite direction. So it didn't do very much for the first year. So from the end of 2007 to the fall of Lehman's in September of 2008, bonds did hardly anything. Most of the action was in low-grade bonds. But generally through that period, bonds moved up. And that's largely because governments cut rates to stimulate demand, and that drove up the value of bonds. Looking even better in the light of a skittish, volatile market, gold, delivered much higher initial returns. So you can see that big spike in the end of 2008, which is where Lehman's fell over and the world fled to gold as a safe asset. And it, over the period, it delivered similar returns to bonds and helped to cushion that downflow. Now, clearly, you probably wouldn't have had a 50-50 portfolio where these two would almost completely offset each other. But some of the bonds and gold equities would have cushioned that blow. We see a similar but probably less dramatic impact in COVID. So again, T-line on the bottom, equities, massive fall, very deep, very short. This is 20 to 21, so it's just under a year. And we saw rapid decline, recovery by the end of the year. So 2020, when you look at the calendar year, actually wasn't a bad year, despite the fact that we had this close to 30% fall from February to March. Bonds were pretty flat through the period, and gold was up initially and ended pretty well flat. So over the period, you would have been largely indifferent. From peak to recovery, you would have been largely indifferent which one you were in, but the ride along the way was much smoother if you had some golden bonds in there. Now, bonds aren't perfectly opposite. Gold's not perfectly opposite. There are no perfect hedges in this world. There is, when you look at the correlations of these things, neither gold nor bonds are negatively correlated to equities, but they're not fully correlated, and that's where the benefit comes from. So when we start putting together a portfolio, it's how these things behave together that matters. So this graph, again, are familiar, performance on the y-axis and volatility on the x-axis. We show here international equities and Australian equities. So Australian international equities, slightly higher long-term growth. Clearly in the very short term, that gap is much bigger and less volatile than Australian equities. And that's largely because when global markets get crazy, investors flock to the US dollar, driving down the price of the Australian dollar. And so that cushions the volatility in your international equities. And that's partly why you don't want to hedge your global equities. That currency buffer, this works in any country where you've got a commodity currency. So Canadian investors, South African investors, Australian investors. It doesn't work quite the same way for US investors. So if you're consuming any US personal finance content on the internet, you've got to keep that in mind. So what you would think looking at this is if I mix these two, I should get a number somewhere in the middle. That would be the human brain's natural reaction to this graph. The truth is you actually end up with a return that's greater than either and a volatility that's less than either. And that's sort of counterintuitive. And that's because these do move slightly independently. They're not perfectly correlated. So by mixing some Australian equities and some global equities, in this case 50-50, you end up with a portfolio that outperformed either at lower volatility than either. And that's a winning move when it comes to investing. You want to be moving up and to the left on this graph. And that's why I get extremely frustrated when I see internet commentary with people going, oh, Australian equities underperform global equities, therefore I should buy global equities. There's two flaws to that. One is this example where mixing the two gives you better than either. And secondly, that's been true in the recent past, but it's not been true over the very long period. So since records began in 1900, Australia's actually outperformed the US. And whether that's true in the future is anybody's guess. The US has been, an extraordinary driver of global growth over the past, certainly the past 20 years, despite its lost decade between 95 to 2005. But clearly, returns on equities are heavily driven by GDP growth, and the US has that in spades. But the point here is that mixing the few gives you a better return than either. So let's now plot some of the other asset classes on this graph. You've got you're right up the top right-hand corner is small caps. So small companies should, over the long term, deliver higher returns than big companies. They tend to be more volatile, and there tends to be much more opportunity for managers to add value. We've got gold up there in the top right, which is sort of odd a little bit. That's not what you would expect. You would say, well, gold is it's a defensive asset. It's a volatile reliever. It's a smoother in my portfolio. And yet looked at individually, it's got higher returns and higher volatility over the last 20 years than Australian equities. Not one that people would intuitively pick. Infrastructure, they're sitting just below international equities. That's again a good smoother. But the important point with these is that you shouldn't be looking at these individually. You need to look at how they behave together. And the Life Sherpa high growth, that's a 90% portfolio, outperformed a 50-50 Australian international equities at lower volatility over the past 20 years. Now, that's not to say that all 90-10 portfolios will outperform. And it contains a lot of stuff that has a lower return than the 50-50 international equities portfolio. Yeah, it's got some infrastructure in it. It's got some real estate in it. It's got some gold in it. It's got some small cap in it. But when you put all that together, taking into account these correlations, you actually end up with a better return. So both a higher return and a lower volatility. And this is the key nuance that's missing in much of that internet rhetoric. And then just showing an example, well, if you add a bit of bonds to that portfolio, you move to the left. So lower volatility, lower returns. And you pick up a greater decline in volatility than you lose in returns. Absolutely, you're going to have a lower expected return in your 80 growth portfolio compared to your 90 high growth portfolio. And as you add more and more defensive, you drop off the return. And that's fine, because that's how you align a portfolio with your own risk preferences and your risk horizon. So what does this all mean in practice for your portfolio? Well, really, lower volatility leads to lower variability in your future outcome. It makes it easier to stay the course, and it gives you a greater probability of achieving goals. And this is especially true when it comes to retirement income. So if you seek to get a higher expected return, but you take on a proportionally larger increase in volatility, your safe withdrawal rate in a retirement case will actually fall. Now that's counterintuitive, but the maths is clear. And so we can sort of see that over time. So looking at, it's a bit of an obscure graph here, but let me try to explain. So the vertical line is annual return, and the horizontal line is the time for which you're invested. So it assumes a single investment up front, and you look at what your variability returns are over time. And the outside lines represent the 50-50 equity portfolio. And you will see that the expected returns, the bar line in the middle, they're so close on this graph, you can't tell them apart. But starting at the first year, very high variability. So for 100% equity, the top 1% of years, you'll make 50% or more. And in the bottom 1% of years, you're going to lose 30% or more. So huge variation in outcome. So if you're investing for a year, that's not an appropriate investment. Our diversified portfolio, you lose a little bit on the top end. You give up a bit of return, but you pick it up on the bottom end. And over time, as you get more and more years in the mix, you tend to close the gap around the expected return. The expected return being the median return, the 50%. And so in this case, you end up with, after 20 years, with relatively narrow ranges of returns, although in dollar terms, they can be very significant. But the range of outcomes for our diversified portfolio is narrower, and the bottom return is higher. You do give up some on the upside, on the extreme upsides. But when you're looking at most goals, a massive outperformance of your expected return doesn't really help you in advance. And it certainly doesn't help you when you're looking at withdrawing a retirement income stream. So the fact that the red line, being the lowest percentage of the growth portfolio, is below the shaded teal area, means that my safe withdrawal rate will be lower for that portfolio. So moving along, that then flows into the probability of achieving my goal. So if we take this investor who's going to invest $100,000 on day one and has a goal to have $387,000 by year 20. And to do that means they need to realize a 7% annualized return over 20 years. And they have a choice of investing in 100% equities return, which does have a higher upside, or in a lower volatility, slightly lower return portfolio. And so what you see is in the early years, because of that potential for massive outperformance, there are very few periods in which it occurs, but there is a probability that you might achieve your goal very early on. Very low probability. So there's a 20% probability with our equities portfolio that we could get to our $387,000 within a decade. Massively outperforming our goal, and everyone's happy. But that's a very small probability. When we start looking at probabilities that are more like ones that you'd be comfortable with, the 50-50 probability are not dissimilar. But when you're looking for higher probabilities of achieving your goal, our diversified portfolio delivers us 99.9% probability of getting there by year 20. That's only about 85 to 90% for our equities portfolio. So you really can't look at expected returns in isolation. The longer the period you're looking for, the more volatility you can accept. But you've got to align the asset allocation, the expected returns, and the volatility to your goal and your horizon. So if you actually needed a 10% return to achieve this goal, you would miss your goal half the time on either of those portfolios. And that's not a good look.